Hi everyone, my name is Alec P. Tuckman. I'm a financial advisor in the Los Angeles greater area. Today we're going to talk about the basics in investing. So I know if you Google, for example, the word investing, you'll come up with upwards of millions of results. So I'd like this video to be something of an entry point to get people started so you understand the basics of investing and why you're even making that move towards investing in your future. So let's go ahead and start with the two different types of investing. So the two types of investing are investing for growth and investing for income, two very different strategies. So what does the formula look like? So if you look at a formula, it's going to be total return equals growth plus income. So what does that mean? Now, the first question is, what is growth and what is income? What is the difference? People confuse the two a lot, so let's talk about that for a second. Growth is when you get into, let's say, a share of stock. Let's take Chipotle, since Chipotle, there's a Chipotle next door to me. At Chipotle, let's say you get in at 400, you hope to God it goes up to 500. When you keep your fingers and toes crossed, you're hoping that stock goes up, the share price goes up. And only when you cash out do you make the money. Otherwise, it's a paper loss or paper gain. One client put it to me in one way. They said it becomes real once you actually cash out, right? So that's a growth strategy. So what is an income strategy? An income strategy is very different. When you're looking at an income strategy, you're focused on what's called the interest and the dividends. Interest is usually what you get with bonds. Dividends are what you get with stocks, right? Dividends are usually paid quarterly, on a quarterly basis. Interest is usually paid every 6 months with a bond, for example. So what does that mean? So if you talk to someone in the market, usually if you ask them, what kind of a return should I expect? They're usually going to tell you around 10%. And yes, this is going to vary advisor to advisor or Wall Street broker to Wall Street broker. But generally speaking, you're looking at about 10%. How is that broken down? Generally speaking, they're going to tell you it's going to be 7 to 8% with the capital appreciation. That's again the growth. And then 0 to 2% on the interest and the dividends. That's the income side of things, right? So that's what they say you're going to average in the market. Now we have to be very careful because when we use the word average, that can be something misleading. Mark Twain had a really great quote. He says, there's lies, darn lies, and statistics, and really all three are the same. And I kind of agree with that on some level. What do I mean by that? If, for example, I were to tell you that between my wife and I, we jog, on average, about 10 miles every week, right? That sets a particular picture. But then, if I were to tell you, for example, that she actually runs 20 miles, and I run closer to 0, that's a little bit more oriented towards the truth. However, that paints a different picture, and really what we're saying are actually the same things, even though we're positioning it in different ways. How does that affect you? How does we apply that to investing? So with that in mind, for example, that 10% is over the average, the duration of the market. What they're not telling you is if we have drops, so we have low points in the market, then that basically infers that you're not making money in certain periods. Right? So when they say averaging, that's over the course of a long period of time in the market. That's not accounting for certain periods. For example, from 2000 to 2002, we had a huge stock market drop due to the tech crash, right? Then we had another period of about 2000, really the end of 2007, beginning of 2008, all the way down to 2009, where we saw another market correction due to the subprime meltdown. No money was made in that time, right? Unless you're shorting the market. So with that in mind, understand that if you're a retiree trying to live on your 401k, your 457, your 403b, you're not making any income in that time. What does that mean? That means you have to sell shares to be able to survive. But that's something you want to really avoid. It could be catastrophic. It becomes something of a slippery slope when you start selling shares to be able to survive, right? So let's go ahead and get back to the growth versus I. So again, growth, that's like a stock, for example, or a common stock, where again, you're hoping the market goes up, and that's how you make the money, right? So in some cases, things like the income side of things, those are represented by things like bonds and bond-like instruments. With bonds, you're getting interest, where over time, regardless of the market, you're still making income. If the market goes down, you can potentially still make income as long as you hold the bond duration. And of course, the bond doesn't, the company doesn't go into bankruptcy. If it's a corporate bond, you're going to be fine, right? So again, growth is what you're essentially doing in your 20s, your 30s, your 40s. But then people don't understand you have to make that paradigm shift from a growth strategy to an income strategy, where once you hit your 50s plus, then you need to start reallocating your assets, and you have to figure out where you're going to put your money, where it's going to essentially work for you. Either you're working for your money or your money is working for you. That's a very important concept. Even more important as a concept is money on a fundamental basis was meant to be employed, right? You have to get the money working for you. And that's why right now with bank interest rates being where they are, near zero, that can be, you're basically money sitting dead in the water, right? Again, you have to get that money working for you. That's a very important concept. At the very least, you need to make sure that you're hedged against inflation. Inflation, on average, is about 3 to 4% in a given year. So with that in mind, if you're not making at least 3 to 4%, your money is slowly going down. We call inflation in our office the silent pneumonia of your portfolio, because you don't know it, but it's really actively eating away at your funds. So it's important you employ that money. Unless our bank accounts are getting us, good rates like 5, 6, 7%, whatever, then you need to make sure that you're getting good rate of return. Otherwise, again, your money's eroding. So you need to make that paradigm shift from the growth to the income strategy, and that happens about age 50 or so. So with that growth strategy, again, you're not counting on the stock to go up. You're not keeping your fingers and toes crossed, hoping that the stock price will go up. What's happening essentially is, even though the value of those assets may fluctuate, you want the consistency in income. What essentially you're looking at is almost like positioning your portfolio like a rental property, wherein even though the value of that property may fluctuate and go up and down, it's irrelevant, right? If you have 5 to 10% market fluctuation, why do you really care? All you care about is the consistency of the rent, if we're using that house, the rental property metaphor, where you're getting, let's say, $1,000 a month or whatever. So it doesn't matter about the mild fluctuation of the price. It's all about consistency in income being generated. And that's really the key to retirement planning on a very fundamental basis. Now, in getting back to this area over here, we talked about how, that 10% misconception can be something of a misnomer, because 10% in some cases really isn't 10%. So with that in mind, there's a number I want you guys to etch in your brain. Generally speaking, 4% is the number you're going to need in your retirement, where most people don't have to dip into their portfolios to cannibalize your portfolio, to sell shares of stock to be able to survive, right? So with that in mind, if we look back, and I'd say this is par for the course, as you can imagine, I look at probably 3 to 5 different portfolios in a given day, right? All day long, all week long, all year long. I look at nothing but portfolios. And I can say without question, it's generally 0 to 2% in terms of the interest and dividends, right? So that's fine in an up market, but in a down market, how are you making money? The answer is you're not. That's why it's super important you focus on the interest and dividends as well as the capital appreciation.